All right. Hi, everyone. Welcome to Weston's Financial Literacy Club's online webinar.
We're so excited to have you all here tonight. We're going to be diving into some kind of essential investing tips that we feel that every student should know, but also open to just people who are open and willing to learn more about investing. My name is Amy,
And I'm Mary.
and we will be moderating this webinar tonight.
As students preparing for the future, understanding how to invest wisely and build long-term wealth is more important than ever. Whether you're brand new to investing or just looking to learn more, you're in the right place.
Tonight, we're incredibly honored to welcome our guest speaker, Mr. Jeffery Mortimer. Mr. Mortimer brings decades of experience in investing and most recently served as Director of Investment Strategy for Bank of New York Mellon Wealth Management. Also, before we get started, if you have any questions throughout the meeting, feel free to drop them in the chat at any time. We're going to have a Q&A session at the end where you'll have the chance to ask questions.
Um, I'm very excited to announce and introduce our guest speaker, Mr. Mortimer. Thank you for being here tonight, and then we'll turn it over to you now.
Wonderful. Thank you guys very much. I appreciate it. Although I'm at the end of my career and you guys are at the beginnings of yours as you embark to college and then move on from there, I'm going to do the best I can to put myself back in high school. And I tried to present to you what I would want to know as a high school student, starting out in either investing my own money eventually or in having a career in finance and investing. So I'll touch upon both of those, but I'm really honored to be here with you. These are a lot of fun for me. I love to give back to communities, and I'm really honored to be asked. So this is my formal resume, as it were. I grew up in Maine. I grew up just outside of Portland, Maine, and graduated from high school in 1982. I went down to Babson College in Wellesley. I mean, it's so funny. It's in the next town over. But for me, it was moving away a few hundred miles and going to college in Boston. So I did graduate from Babson in 1986, 4 years, and then worked in Boston for about 4 years or so in a few jobs, and then went to the University of Chicago to get my master's in business administration in 1992. Along the way, I did get my chartered financial analyst. So I took some additional testing and credentials within my expertise, my arm of expertise. And that was when I sort of quit educating myself formally. But I was 35 years old when I sort of got my CFA and sort of stopped formally learning. It is a career path which requires continuous learning. And if you're not curious, don't go into investing. You have to always look at the current and predict the future and take all the information that you have and sort of learn every day. So it's been a wonderful career for me, very exciting, great people, a lot of responsibility, and some wonderful friendships and camaraderie along the way, as you can imagine. I did move to San Francisco. I spent most of my career in Boston, but was 13 years in San Francisco when I worked for Charles Schwab. So you can move anywhere. A lot of people, New York, again, really the financial spokes of this country are in San Francisco, New York City, Chicago, and Boston. That's where you'll primarily find yourself in the investment world potentially. Although now with remote learning and remote work, you can be anywhere potentially as well. Why don't we go to the next slide? My agenda for you would be talking a little bit about investing itself. We'll get to the career part later, but I also want to hit upon you how important it is to begin investing as young as possible. You have an asset that I do not have, and that is time. And the ability to compound returns is amazing. If you start investing at 20 years old, for example, and begin to put money away into the stock market and just did that for 10 years until you're 30 and then stopped doing it, you will be ahead of a person who starts at 35 and does it for the rest of their lives. It is incredibly important to start early with whatever money you can muster either from a parent account or some gifts, graduation gifts, whatever the case may be. But to start investing as early as possible is an amazing advantage that you have over others that are older than you. We'll talk about the stock market. We'll talk about the bond market, even if you don't know what those definitions are, how to manage your own account and what important thoughts I have there. Again, current day, what should you be, as you read the headlines, what should you do about your investments when you read that, Trump is president or Biden is president or a war breaks out, right? All these other things we can talk about. And then we'll get into a career and talk about if you wanted to pursue a career in investing, sort of what would that look like? And then 40 minutes from now or so, we'll do some Q&A. I'd love to hear anything on a career. You can ask me anything personally, or we can talk about investing, whichever ones you wish. So why don't we go to the next one? Let's talk about investing. And there are, and again, some of this is jargon or vocabulary, but you have to learn the vocabulary in order to learn kind of what people are talking about and what particular investments, what they do in a portfolio. Current, common types of investments are stocks. This is ownership in a company, McDonald's or Nike, right? You actually, if you buy a share of stock, you are buying a sliver of the ownership of that firm. If you had enough money, hundreds of billions of dollars, you could buy the company, you could buy the whole company if you wished. These companies, but they sell shares of themselves, little pieces of themselves that trade on the New York Stock Exchange, for example. If you get into bond investing, that is lending money to a company. You're lending them $100, they pay you an interest rate, and then at the end of the period, the maturity comes, and they give you your $100 back. So you don't have the risk of a stock, which can move up and down. A bond is much more conservative. It pays you income, and those two work together over time very well. You can purchase real estate, either an office building, a piece of an office building, a piece of a commercial property, a warehouse. You can buy residential real estate. You can buy multi-properties within. Then again, there are funds that do this for you, or you can, as you live your life, you can live in one home and buy others for investments. All those types of things can also be done. You can buy mutual funds. These are commingled investments. So you're investing your money alongside thousands of other shareholders. So they are pooled investments, and you have an expert manager on the top that you're paying him or her a fee to manage your money on your behalf. They're the expert. You ride along with them. You can invest in a business, right? You can start up a company, right? All these things. This is also an investment. It's a concentrated investment in yourself or in an idea. And so those things can happen in your life, and those can be very good investments potentially. They carry risks. Single company it either will do well or poorly, where other investments are more diversified, but that's another way you can go. You can buy gold and other types of commodities if you wish. That's probably more deeply than we'll get into here, but those are another type of investment. And finally, Bitcoin, Ethereum, Solana, right? All these other cryptocurrencies are also becoming types of investments that you can now put in your portfolio and trade also on the New York Stock Exchange. These are becoming much more mainstream over the past couple of years. So you can see that types of investments can run the gamut from stocks, bonds, real estate, right? All these types of things. But these are the major types of investments that exist today. Next page, please. Let's talk about the stock market. That word is thrown around a lot. The best way that I can summarize what a stock market is, it's like going into a used car dealership, not a new car dealership, but a used car dealership. All the stocks that are trading on the New York Stock Exchange are owned by other people, and they are selling their cars or their stocks to you at a given price. A company doesn't get any money from the stocks that are traded on the New York Stock Exchange. McDonald's can occasionally issue shares into the stock market, but those are very rare events. Companies that do that for the first time is known as an initial public offering or an offering of shares. That is the only time that the company is in the marketplace getting your money. Other than that, the stock is trading between investors. So please understand that. Again, a giant farmer's market was what I put in the text, but a used car lot is also a nice way to look at it. Companies do sell again to raise money for themselves, but most of the time, again, you're trading with other people. So again, think about it as if you were going to open a lemonade stand, let's make it in basic terms, and you didn't have the cash to do so, you could put together shares of stock, write them on a piece of paper, and then sell them to your friends and say, if you give me $1, I'll give you a piece of paper. They give you all that money. You run your lemonade stand and make profits and give them to people who lent you money or who bought your stock to begin with. That's how the stock market works. And companies do that through dividend payment, right? They pay their stockholders, right, a portion of the revenues or the income that they make on an annual, typically on an annual or quarterly basis. Next one, please. So how do you make money in the stock market? Of course, you make money by buying a stock at a lower price, then you eventually sell it. This is known as capital gain. You buy, for $100 and sell it for $200, and you make, or sell for $150 and you make a $50 profit. So that's wonderful. That can also go the other way. You can buy it at 100 and then the stock price goes down because the company's not doing as well and people are less enthusiastic about it. And so a stock price can also fall. So you have to, as you buy a company, be confident about their future revenues, growth prospects, that they will keep up or dominate their competition. So all these types of things can happen within the stock market. It can be quite risky or volatile, as they say. Keys to understanding is diversification. Buying one stock can be risky. Buying large baskets of stocks, there's known as the S&P 500. These are 500 names, 500 stocks that people purchase within an ETF or a fund, and they're managed for you. You pay a very slight fee for doing this, and you own quickly 500 companies. And so you're not picking individual names, but you're riding along with the U.S. economy, and that the U.S. over time will do well. Way to start investing in your portfolios to gain exposure to the stock market without having to do a lot of research into individual companies. I also would say to you, please try to buy and hold things, especially an index fund. Buy what you can and then hold on to it for long periods of time. I talked to you about the power of compounding, and that power is amazing when you have time on your side. When I was just starting out, the Dow was at 2000 in 1985. You can go look, we can all go look it up. It's now at 40,000, 35,000. So you think about 2000 to 17 times your money. Yes, I'm older, but if you put $1,000 in, it's 17,000. If you put 10,000 in, right, you can all start to do the math. And if you put that money in over time, you can see at the end that there's a large pot of money waiting for you, potentially at retirement. I still will argue with most people that although most people my age will say that real estate was their best investment, the home that they purchased, stock market actually beats real estate prices. It really does, about doubles the return on real estate over time. So please don't sell it, right? Don't sell it short. The stock market is a wonderful place to compound money over long periods of time and to reward yourself when you're 40, 50, 60 years old with a nice payday or nest egg that can carry you on for the rest of your life after you're done working or want to move to part-time or whatever the case may be. Next slide, please. The bond market, I touched upon this already, but the bond market is the opposite of the stock market. Stock market is owning a piece of the company, and you get paid last. You get paid profits, right? You get paid what the company has left over after it's paid all their employees, all of their leases, all of their rents, all of their taxes, right? Everything has to go through the filter, and the stockholder gets what's left. Successful companies, that can be wonderful, right? Because they pay all their fixed costs and they have a lot left over. A bond, like I said, is different. It is a loan to the company, and it is a contract to the company. I will loan you $100. You will pay me 5% a year for 5 years. And then at the end of the 5 years, with the last interest payment, you will give me all of my money back. So as long as the company is surviving and doing well and can make those interest rates and principal payment back to you, you have enjoyed a wonderful return without a lot of variability. Notice it has a lot, right? It's income, It's income paid to you every year, every quarter, every half year, and then it's all your money back at the end. So it's really like an IOU. Again, it's the key to a bond is the interest rate that you can get on that bond. If you can lend money to the US government, you can lend money to corporations, you can lend money to other countries as well. So there's a lot of ways to play in the bond market. And you have to just make sure of a couple of things. The interest rate that you're going to collect on the loan, and then will that company or country be able to meet those obligations? So you have to do some research if you're buying an individual company bond that that company will still be in business because your principal, your loan amount to them is of course at risk if they cannot pay you back at the end or they run into competition or trouble, bankruptcy, right? All of a sudden that what you thought was a safe investment now turns out to not be a safe investment. The safest bond investments are, of course, to the US government. They cannot really default. They have a printing press in their basement, so they can just print money to pay you back. That can cause other issues that we won't get into on this call, but you can lend money to the US government, make a rate of return on it, and be guaranteed, right, that your money, your principal, will be paid back. The Treasury bond market is the largest bond market in the world, as you can imagine. A lot of people, foreign governments, individuals, companies, all lend their money to the US government, of course, to get payment and interest back on that principal that they lend. So that is the bond market. Less risky than stocks, paying a different type of stream of income. A lot of people, a lot of wealthy individuals and families have both stocks and bonds in their portfolio. What I would recommend to you at this early age in your late teens, no bonds. You don't really need them in your portfolio. You don't need income. You need appreciation. I would put most of my money, if not all of my investment money, into the stock market. And then what your income is going to be is not from the bond market, but from your work, your human capital will collect that income. That your paycheck will be your, right, your monthly income or your every 2 weeks when you're paid, that's your income. Let your investments really work for you, especially when you're young in the stock market. As you get older, there is a certain rules of thumb. 100 minus your age can be put in the bond market. So if you were 50 years old, 100 minus 50, 50% in the bond market and 50% in the stock market. So when you're 50 years old, when you're 60, you'd have 40% in the stock market, 60%, right, in the bond market potentially. So these are, again, just rules of thumb, but they show you that as you age, you will put more in the bond market. But at this age, like I said, I want to have most of your money in risky assets that bounce around a lot, but give you a great return on the back end. Let's go to the next page. How to manage an account. First thing you have to do whenever you're managing an account is, what is the purpose of the money? What is the purpose? Is it for a short-term issue? Like I have a goal of buying a car. I'm saving for a car. I'm helping my parents pay for college, right?
它 recorded 吗？不知道
I
会
want to buy something in a given period of time. So if you have a given period of time, all of a sudden, right, your investment horizon shortens and you can take less risk with that. Say in 10 years, you want to purchase a home. So again, 10 years, you get 100 minus 10, and you start to say, oh, wait a minute. So I have to have bonds in that portfolio, not just stocks. So the most important decision you make is how much stock versus how much bond. And the shorter the time period, the more bonds you need in the portfolio and the less stocks. So retirement account, like I said, mostly stocks. A 10-year or 5-year, you feather in bonds in that portfolio to give you income and to have that money grow with income and not so much with stocks. Maybe if for 10 years, you might be 70% bonds and 30% stocks, or 60-40 or something like that. So the most important question that you must ask yourself is, what are my goals for this pool of money? And you can have multiple pools of money. You can have a pool of money for a car, a pool of money for a house, and a pool of money for retirement. And notice that each one of those will be managed potentially quite differently. But that is the way to think about it. I deal with wealthy clients today, 30, 40, 50 million of net worth, and they have buckets. They manage their money in various buckets, some for their children, some for philanthropy to give away, some for legacy, right? After they pass, right? So they are looking at all of their buckets, and we are managing each one of those buckets separately for them to meet their investment goals for that bucket. Please do the same thing. Please start with a small amount as you begin to practice, right? Especially of individual stocks. Learn from your mistakes. It is trial and error, a lot of this, as every individual learns about what they can stomach for volatility and what's it like to buy an individual stock. Robinhood, right? All these companies are set up for very low amounts of money. And you can really begin to practice with $100, $50, those types of things that can allow you to really get an idea of what investing is like. I started with small amounts of money back when I was a kid. I bought my first stock when I was 13 years old. And I learned how volatile they can be. And, oh, I thought that was a good idea, but it wasn't. And then learn, why wasn't it? What am I missing? And each of those trial and error misses will help you become a much better investor. And then just see if you like it. Fidelity has accounts. Acorns is wonderful through CNBC. Robinhood is a great one. My niece just told me of another one this morning when I was having breakfast with her, but I can't remember it. Smash or something like that. Anyway, they're popping up all over the place. But the help is here for all of us to learn as we go. And I would really press upon you all, whether you're going to go into investments as a career or not, just play around with investing and see what it's like. And you go. And making mistakes with $50 is much better than making them with $5,000 or $10,000, right? Making those types of mistakes can be costly and takes more time to recover. Let's go to the next page. Managing account continued. So as I mentioned before, I want you to consider index funds at first. These are index S&P 500, for example, the SPY that you see right there in the middle of the page. That's an ETF that charges almost no fee. It's almost free, not quite, but almost. And for that investment, you get all 500 companies, and you'll watch it, move through time. It'll go up and down, but does tend to go up about history for 100 years of the history of S&P 500. It goes up about 10% per year on average. Now, it can be flat in one year, go up 20 the next, go down 5 the next year, go up 15 the next, right? You get those types of returns. It's not 10, 10, 10, 10, 10. It averages 10. It's lumpy. But if you continue to invest in it, notice when it goes down in price, you're buying more. When it goes up in price, you're buying relatively less. So this is known as dollar cost averaging. There's a lot of things that you can do to smooth out your returns. And to, again, like I said, at the end of the day, a wonderful way to invest money. Please avoid there's right. I have Instagram, and there's so many get rich schemes and trading options and doing all these things. And I just say, be really careful on those things. If these people were experts, they would be employed within a company and would be doing it professionally. A lot of these people are out to, if it works so well, why are they selling it to me? Why are they giving away their secrets to me? All these things you have to please be very skeptical of those people saying, I'm an expert. Let me sell you something for, $29.99 or whatever the case may be. And so please, you have time on your side. You will get rich investing slowly but surely. That's the best way to do it. So again, thinking long term, it is your greatest asset that you have. And it's boring, I understand. But as I sit here at 60 years old, my investment portfolio has served me well my whole life. And it can do the same for you. It can provide you with income stability, all these things. And starting young builds that up really quickly. And before you know it, you've got a pool of money that's all of a sudden really working very nicely for you. So again, if you $1,000 at the age of 17 and earn 8% a year, the average market return or so, not including dividends, it'll grow to $21,000. So 21 times your money. You just think about 21 times your money in 30 years. So the power of compounding is amazing. And I cannot emphasize it enough, how important it is. Again, 1,000 to 21,000 without adding a penny. Let's go to the next page. Again, as I emphasized at the beginning, it is imperative that you are curious as an investor professionally, right? If you're not, just dollar cost average into an index over time and you'll be fine. But there are wonderful resources out there for all of us. In YouTube, there's a few places that I like, especially the Plain Bagel I find very interesting. There are books that you could read, old-fashioned books, audiobooks, go to the library, whatever the case may be. Little book on common sense by Bogle. He was an indexer. He's recently passed away. These are men with decades, 50, 60 years of experience. I will teach you, to be rich. There's podcasts, there's everything out there that you can search for and listen to that will help you learn about what investing is and isn't. Always please for staying safe, because online can be dangerous. Please go to a place like Charles Schwab or Robinhood or Fidelity. You will be placing your money in places where you want them to be around. Okay, the fly by night, a lot of people, there are so many scams and schemes that go on. Children aren't targeted as much as the elderly are targeted, who have money and who fall into these cracks and crevices of people who are coming after them and taking money from them. Never invest more, especially in the stock market, than you're sort of willing to lose. Like I said, please start small. Important to start small, because you're going to make mistakes and you want to learn with small amounts of money. Ask questions before clicking. Again, ask people, am I doing this right? What is happening? Schwab, Fidelity, Robinhood, they'll have seminars for investors. Join some of them. Learn from other people. It is really interesting to, like I said, you have to be a lifelong learner. But if that is your mindset, it's a wonderful place to start and to learn from others and what they're thinking about. Let's go to the next page. Current events. Everyone asks me, and this is my job at Bank of New York Mellon, was helping clients navigate current events. They are incredibly important to know about. They do affect stock markets, especially in the short term. You can get economic events like inflation, which is the rising costs of goods and services. You can get jobs data. Are people getting employed by companies, or are there layoffs? As we talked earlier, interest rates, these are the interest paid on bonds. These are incredibly important, and they do fluctuate. Politics are incredibly important. Elections, the Trump election versus Biden versus Harris, right? When Obama was elected, a Democrat versus a Republican, that matters or can matter. So all these things you have to think about. Government shutdowns, tax laws, all these things have to be taken into account for how the stock market does and how people feel about themselves, their prospects, and the economy. World events matter as well. Wars, Russia invades Ukraine matters. It affects oil price. It affects all these other things. Pandemics, unfortunately, we've recently all lived through COVID, and that was very disruptive to supply chains. And as I was speaking around the country, really around the world, I had to become a virologist to people about when will COVID end, how deeply, what does it mean? All these other things that you have to become knowledgeable about in order to make proper investment decisions. Company news, specific news, Apple building in Japan or China, I'm sorry, putting phones together in China versus India versus the US. All these things matter for the stock. Trump tariff individual companies, all these things matter, right? And trying to forecast those, anticipate those things are incredibly important to become a successful investor. Think of the stock market again like a crowd of people, a very smart crowd of people, but they're all in a room and they're all talking and they're all making decisions at the same time, gathering the same information. And so how those events happen and how they change the mood of that room can be very important. And their guesses about both the present and the future can make the stock go up and down as they think about that company and its prospects for future success or headwinds. So again, very important stuff. And so again, as an investor, you have to think about all these things. But as an indexer, if you just buy the S&P 500, you sort of let the world take care of those things. And you say, over time, the market goes up. I'm not going to worry about these things so much. But if you're going to invest in individual companies, all of a sudden you see all these things start to potentially weigh on you and take time to analyze and invest and talk to others and sort of figure out, what do I know that they don't know? What does the room full of people know that I don't know? And what do I know maybe that the room full of people doesn't? Where do I have an advantage as an investor? These are the keys to good, to proper investments over time. Next page. This is oversimplified, but when good news is presented to the room of people, stock market tends to go up, right? A company reports record profits. The lemonade stand, right, is doing incredibly well. The stock, those shares of stock that the friends now hold are much more valuable because you start to pay out a lot more money for those shares because you're making a lot more money at the lemonade stand. The economy does better. It's adding jobs. It's growing. That means that most companies will be able to sell more products, right, or charge more for them, right? Those types of things. So that's wonderful. A country ends a war. Russia and Ukraine find peace somehow, some way. All else equal, the stock market should go up, right? When the war is over, there's more certainty, and so current events matter, and stocks tend to rise when news is good. The opposite is also true. A company's earnings are worse than expected. Competition is more fierce, or just demand for their product has gone down. All of a sudden, people say, well, I own that stock, but I don't like it as much. They're telling me that things are weakening. And so you're going to start to sell that and maybe buy a company whose prospects are better. New virus, right? Something out of the blue. A pandemic, COVID-19, right? Stocks plummeted on that news, down some 25 or 30%. They recovered nicely after government stepped in to help. But when COVID first came out, the stocks fell almost in a waterfall. People didn't know what to do and certainly didn't want to hold stocks where the world might be shutting down for a period of time and what that might do to profits and sales, right? You can imagine. So it was sell everything, and prices fell precipitously. Major bank collapses. This happened in the late 2000 aughts, so 2008, 2009. There were bank collapses as the economy and the global financial crisis hit. And so again, people are very nervous and sell stocks in those types of events. Hard to anticipate, especially COVID-19. But the other one was potential to anticipate, did provide a wonderful buying opportunity for those that were not flustered, but did hurt stocks for a number of years. Let's go to the next page. Let's talk about careers. If you sort of like what you heard and said, boy, I don't just want to do this for myself, but maybe I can help other people do this as well. I turned it into a 35-year career and still do work for a small firm out of Los Angeles. I've downshifted, but still, once this is in your blood, it's really hard to get it all out. There are various investment careers within investing, and some that you may have heard: stockbroker, financial analyst, portfolio manager, trader. Stockbroker really brings together buyer and seller, and more of a salesperson than anything else. They do wonderful work, but they make investors, especially retail investors, aware of certain stocks that they would not find on their own. So they provide advice to you in your portfolio about what stocks you should be buying. Financial analyst tends to sit within a company and analyzes other companies like Nike or McDonald's. And they are paid to analyze these companies and decide whether that firm that they work for should buy McDonald's or not. So again, people have handed their money to other companies to invest for them. And now those companies that now take this money in have to decide what stocks to buy. Financial analyst works within a company like that to decide what stocks to buy on behalf of people who have given their money to that firm. Portfolio manager sits typically above a financial analyst and makes the final investment decisions within that company. A trader sits there and goes to the marketplace, that room full of people, and navigates through them, buying and selling stocks efficiently. So he or she is a person who works and just trades the names that the portfolio manager and financial analyst have decided to buy or sell. The trader does that as smoothly as possible without disrupting the marketplace. Good traders are worth their weight in gold because they're able to navigate through and not create any ripples. When you sell a stock, you don't want people to know that you're selling it because that may cause other people to sell theirs, driving the price down. If you're buying a stock, you don't want other people to know that you're buying it because that may cause the price to go up, right? If everyone starts to buy in front of you. So a good trader is wonderful. Investment banker helps individual companies go public, right? I talked about that at the beginning. If I'm a company and I want to sell my shares into that room full of people, I need an investment banker to help me do that. And finally, a wealth advisor is a person who deals with wealthy families and individuals, endowments, and helps them navigate and create a portfolio to meet their investment goals. So it's a long list. This is just, again, a sample, but you can see you can take this anywhere that you wish to go. Like I said, from either helping people buy stocks to helping wealthy individuals and families create a whole portfolio, goal-oriented portfolio. Let's go to the next page. What can you do sort of in high school? Important to take mathematics. You will have to get into calculus, and first and second derivatives matter in my industry. Rate of change is important. But that's about it. This is not physics, right? You're not solving black hole and dark matter, but you do have to know basic mathematics, regression modeling, statistics, those types of things. I would join investment clubs if you want to, right? And have a pool of money and learn, like I said, learn how to manage money with small pools of capital or experimentation. These things are incredibly important. Stock market simulations, a lot of firms will offer a fake portfolio. They'll give you $100,000 of fake money, and you can trade that. So you can go and just as you're buying and selling stocks, but it's not real money, it's points. But the stocks really trade on the stock exchange, and you can see whether or not you're winning or losing. Watch TV, CNBC is a good one. The Motley Fool is a nice little online expertise. So there are people that can help you invest in it. I like some of the websites, some of the more factual websites, such as those that are mentioned, Bloomberg. After high school, again, you'll probably have to major in finance, economics, accounting, something like that. Finance programs within Wall Street, again, NYU, Wharton has wonderful ones, Michigan, UT. There's wonderful finance schools. Ohio State has a wonderful finance school. Learn more about certificate programs later on in life, including the one that I have, a chartered financial analyst. So again, you'll learn throughout your life within this industry. It's wonderful, but there are people along to help you and guideposts along the way to make sure that you're on the right course. Next page. Gain experiences early, like I said, internships, investment clubs. Build a LinkedIn portfolio, telling people that you manage money. And again, virtual stock simulators that I mentioned before. Learn skills that you'll use. These are important, not just the hard skills that we talked about, but public speaking and presenting are incredibly important. Writing, believe it or not. AI has helped me significantly over the last few years with writing. But it is important to communicate, right? You're not only making decisions, you're communicating with others. Coding, I think a little less so, especially in terms of what AI will eventually do. But reading financial statements is always going to be critical, although AI can help there too. I think AI is really going to have an impact on this industry, as we go forward. But the writing and the presenting and understanding and assimilating information, I think will always be human-based. and those softer skills are going to become more and more important. Next one. Again, staying informed and inspired, continuous learning, unfortunately, for better or for worse. Some people, boy, I just want to learn it and then apply it. This one is a little bit different. I mentioned the podcast before that I think can continue to be very important. Books. These are kind of The Random Walk Down Wall Street is a wonderful, wonderful book written a long time ago, but really talks about how efficient that room of people really is and how tough they are to beat. And I think coming from that perspective is incredibly important. The Intelligent Investor is almost 100 years old. This is the one that Warren Buffett uses as his Bible and is something that's a little bit dry, but it's something, again, if you want to skim and think about investing and buying 50 cents on the dollar for companies, this is a wonderful book to start with. And even Warren Buffett Speaks. It's one that I've recently read about 6 months ago. And again, Warren Buffett, one of the greatest investors of our time. It's a wonderful book, not too hard to read, that summarizes his views on markets and investing. And it's a little hardcover, an inch thick, So my final advice, again, start now. As I mentioned, I cannot say that enough. Important to start now. Ask questions. People are willing to help you. Parents, friends of parents, these types of forums, we're here for you. And as I mentioned, it does require curiosity. I think to be a good investor requires that you remain curious, constant learning. How can I get better? And if you like those types of challenges as you go through life, it might be a wonderful career to consider. So I think we've hit just about the end. I think I'm on time. There's I saw, I think, some questions coming through the chat. Sorry, my computer came unplugged. I just want to plug it back in. So yeah, any questions that any of you have would be wonderful. Mary, do you want me to go into the chat itself?
Yeah, we can actually just read out loud the questions for you to.
That'd be wonderful. I'm looking at them too.
Right,
Sure,
perfect.
go ahead.
So the first one is, how do you access the stock market? Probably on like a mobile device.
Yes. So you can download an app like Robinhood or Charles Schwab. The good thing about Charles Schwab, for example, Robinhood has no branches, but Charles Schwab you can literally walk into a branch, knock on the door. You don't have to knock in. It's like going to the Bank of America branch in Weston. When you walk into the bank and there's some people around, you could also do the same thing, walk into a Charles Schwab branch. Trying to think, there's one in Chestnut Hill on Route 9. So they're around us. And go in and open an account, right? Fill out paperwork, present your license, those types of things. And then you will put an app on your phone. And from your phone, which is what I do, you can buy and sell stocks. I want to buy IBM, or I want to buy NVIDIA, or I want to buy Nike, McDonald's, right? Each of those stocks have a ticker or a shorthanded notation for them. And that's how you access the stock market. You cannot do it through a checking account or savings account. You need a brokerage account. So it's a Robinhood, a Schwab, a Fidelity, those types of things. For me, that branch helps me. The seminars help me, but Robinhood might be maybe for your age easier to use. I'm not sure, but for me, it's Robinhood, Schwab, or Fidelity. And like I said, Schwab has branches all over the place. So does Fidelity. So that's how I would do it. But it will be an app on your phone, and you believe it or not, you will begin trading. You can trade on your phone, track your portfolio on your phone, right? Like everything else. It's amazing what technology has done over the last, this is 10 or 20 years.
Nice. Another question we have is, what are the most common mistakes made by individual investors, and how can we avoid them?
Well, the mistakes that investors make tend to be like you go from a period of time in which you will be overconfident. If you do some research on a company, you may feel, oh, I really know about the company. And it's that overconfidence where you should not be overconfident, where you don't know anything more than the rest of the world knows. So I think a common mistake for novice investors is a cockiness that isn't deserved. And that's why I said start with small amounts of money, because you'll quickly find, oh, I didn't know that, or I couldn't believe that could happen, or I thought the company issued good news, but the stock went down. How does that happen? What's going on? So, the mistakes that we make are that we buy a stock at 100 and it goes to 70, right? And we lose money. So the common mistake is why I bought a stock and why didn't it go up? And so that's a symptom of a mistake. And the mistake tends to come from I didn't know enough, right? I wasn't informed enough, or I thought I knew more than I actually did. And what you'll learn at my age is humility, right? That the market, that room full of people that we talked about that are all trading the stocks, that room is incredibly smart, incredibly smart. I often give the example that if you were to learn how to swim, you would start in the shallow end, not over your head, and you would practice. You would practice and practice and practice, right? And then you'd eventually go to the deep end. And when you were already very proficient in the shallow end. Investing does not offer you a shallow end. It does not offer one. It offers only the deep end. That room full of people, incredibly smart, and they are there to take your money. They are there to take your money because, right, if you're trading with other people, then you win while others lose. It's a zero-sum game, right? You are buying a stock from someone who's selling it to you. Think about why are they selling it to me? Because they think it's going to go down. I think it's going to go up. And so a year or two or three are going to go by and somebody's going to be right on that trade and somebody's going to be wrong. And as you start out, you're going to find that many times you're on the wrong side of that trade, that other person knew more than you did. And that other person, by the way, is Michael Phelps. You are trading against Michael Phelps. So understand you have time on your side, right? You have a few things that are to your advantage, but Michael Phelps is very smart. That person selling to you at that price is very smart. And right? So that's where the mistakes are made. Learn as much as you can. Start small, learn, use S&P 500 index funds, those types of things, and just watch and learn. Okay. So those are the mistakes that we make. We buy wrong, we sell at the wrong time, we get emotional, we sell when the stock is down, we buy when it's too high, right? We're wired sort of to make mistakes. Read those books I talked about, the Warren Buffett, those types of things. So very tough. We are wired to be bad investors. It's very strange. Our emotions cause us to be poor investors. So a lot of times when you're about to throw up because a stock is so low, you just want to sell it, get it away from me, right? That's what the human being, the emotionally is telling us to do. The proper thing is to not sell it, but to buy it. Like when it's all disgusting, nothing can get any better. And the thing is so down and out, but to buy it then tends to be over the long term the right decision. Really weird. So we're way off topic, and this is complicated subject matter that you'll have to find out over time. But using your emotions to make your investment decisions usually puts you on the wrong side of right. So be as unemotional, as robotic as you can in your investment decisions. Those are other mistakes that humans make.
Oops. All right, perfect. And then another question is, if you could go back and give your younger self one piece of financial advice, what would it be?
Yeah, I would invest in index funds and hold them for long periods of time. My father taught me that when I was a kid, and I didn't listen to him, and I should have. It is amazing advice, starting when you're young, and through college, even if you don't know anything about investing, doing that small thing. The S&P, like I said, that $1,000 is 21,000. It is an amazing thing to think about how money compounds over time in a good stock market, and you don't really have to think about it. That is the advice that I would give myself. Eventually, when you're older and want to pick individual companies or work for an individual company that is traded on the New York Stock Exchange, then you can invest in your company alongside others that work there, right? So there's plenty of time to pick individual companies. You don't have to do that now. So to me, it was that I didn't start early enough, right? I didn't start early enough as I invested. I made up for it later in life, but it was hard work. And I was jealous of those who had built an account when they were much younger and were well on their way as I was trying to catch up to them.
Another question we have is for high school students or recent college graduates, what is the best time and strategy to start investing?
Yeah. The best time, there's an old, I think it's a Chinese saying, the best time to plant a tree was 20 years ago. But the second best time to plant a tree is today. So understand, right, that the best time was always, 5 years ago was the best time to start, but don't let that frustrate you. Start now. So the best time is always, as soon as you have two nickels to rub together, open a Robinhood account or Schwab account or something and begin. And I would begin with index funds and I would just dollar cost average. I would just put money in every month, every quarter, every half year, every birthday, whatever you can do, right? I mean, we come from Weston. Some people are well off, some less well off, but anything where you have a pool of money that you can put away for a few years and put it in and just watch what happens to it. It's amazing. Help you buy your first house, right? Help you buy your first car, right? It'll do a lot of things for you. What's happened to my son is that he saw that account grow so much that he hated to spend out of it, even though, right, eventually went to Europe and spent out of it, but it was making so much money for him that he said, I don't want to go out to eat. I don't want to spend that money because that means that I'm losing its future growth. So once you see it, it becomes addictive to some degree, how well it can perform for you over, even sometimes over short periods of time. So start now, dollar cost average, you'll have obligations, rent and everything else as you begin to adult, but please try to pay yourself first. Pay yourself something first before you spend all your money and do all the things that you need to do. Just try 10% of your money if you can. Pay yourself. Put it in savings that you never see it, so it's not even tempted to go out and spend, if possible. I know it's tough. Everything is expensive, but if you can save a little bit, it can go a long way down the line.
All right, and then another question is, can students start investing even if they don't have a lot of money?
Yes, you can. Robinhood accepts, I think it's, I don't know, $50, $100. I mean, some small amounts of money where you can go and buy even partial shares of companies. Apple is $200 a share, but through Charles Schwab, you can buy a sliver of Apple. You don't even need $200 to buy one share, right? You'd think that's the minimum, but you can buy a sliver of Apple for $10, and you can own Apple for $10. So you can do for small amounts of money. These companies are after your wallet. They want you to start with them because as you grow your wealth, you'll say, I've always been with Charles Schwab. I've always been with Fidelity. I've always been with Robinhood, right? Even because I started as a youngster. And so it doesn't take a lot. They still welcome you in, even if they're not going to make any money on you. They want you as a client for life.
Another question we have is how important is it to start investing early and what are the long-term benefits?
Right. So I hope I've harped on that enough. It is the power of compounding money, the power of earning interest on your interest, the power of earning 10% return. Let's just do a couple year example. You start with $100 and it makes 10%. You now have $110 at the end of year one. So that $110 is now working for you into year two, which makes another 10%. So the 110 has made you now $11, not 10, 11. So now you have $121 going into the third year, which makes another 10%, which makes you $12.10, right? Can you see how the 10% return starts making you more and more money because it's compounding itself, its interest is compounding. So all of a sudden, the $100 becomes 200. That then makes 10% and makes you $20, right? So, and then all the money that you're putting in at the same time is making you more and more money. So the importance of starting early, I cannot overemphasize. It is your greatest asset. And even if you invest between 20 and 30, as I mentioned, and don't invest any more after that, it will grow to a wonderful sum of money by the time you're 65. More than a person who starts at 35, right? And gets to 65 and they're investing a lot more because you've got all that time that your money has accumulated that 35-year-old can't catch you. It's amazing. So if you take nothing away from this call, right? Think about this as a career, maybe, but invest now, invest early, stay diversified, think long term, don't fall for schemes. You will be really well off, and I know it as I was in high school, thinking about myself at this age was unfathomable. But I will tell you, it's the blink of an eye. Just yesterday, I was in high school with you. It is an amaze how quickly life moves. And you can never get the time back. But you guys have it. You're looking right at it. Please try.
All right, perfect. And then we just have a couple more questions, one of which is, how do you determine whether a stock is worth holding for the long term? What are some key indicators or trends that you personally look for?
So let me give you a weird punchline here. Very few stocks are good for holding for the long, long term. If you think you have the stock for the next 50 years, again, you're overconfident. I doubt it. The longer you hold an individual stock, the more likely it is that you will lose all of your money. Companies, even right there, I can name you so many firms that were supposed to be the next thing. Back in the 20s, it was railroads, it was radio. Back in the 70s, right, it was cosmetics, it was Kodak film, it was Avon lipstick. These companies were, oh my God, they can do no wrong. These companies over time get beaten up by competition. They get overly cocky. They lose their way and get too bureaucratic. So yes, you can hold companies, some of them for 10 or 20 years. But the best thing for me, that S&P 500 index, those companies are coming in and out of that. There is a committee that moves companies in and out of that index that sort of keeps it fresh. So I know that people I'm not recommending stocks here today, but there are hot stocks that are out in the market like Nvidia and Tesla and a whole bunch of them that have made people a lot of money. But I will tell you right now on this call, those stocks, the best days of those stocks are probably behind them. You have to try to find the next Nvidia. You have to try to find the next Tesla, because those stocks are very expensive in today's market. There's not a lot that room full of people trading Nvidia don't know. And the price for these names is significantly higher than it was 10 or 15 years ago when AI was just a twinkle. And Nvidia didn't even know about AI when it started. It was not a company that started with AI even in mind. It was a gaming company that did graphics for gaming, and its computer chips were very good because they didn't want any lag in their gaming video, and that helped them. Now AI luckily came along and Nvidia had the best chips, so it got this rush. So even Nvidia, right, thinking that Jensen Huang, he's an amazing CEO, but that he planned this whole thing. No, a lot of companies, right place, right time, off you go. So please be cognizant of holding a stock for a long period of time. it can give you a wonderful rush, but eventually you must let go and go try to find the next one. And clients have a hard time coming to terms with this, but this is what the data show, that the longer you hold a single stock, the more likely you are to go broke. I mean, it's amazing. So individual stocks can make you a lot of money for 10 or 20 years. And then, man, you have to sort of let them go. So I don't know what the next great stock is. If I did, I would tell you right now. But that's why you have to do research and find out where trends are moving and what's happening in the world and how are we going to power AI and all these things. You have to, again, it's a game of chess. It's difficult, but if you're right, the financial rewards can be significant.
Great. We have one last question here, I believe.
Okay.
Are there age requirements to open a Schwab account without parent signatures?
Um, that you will have to look into. I am not a lawyer and I don't know. It might be 18. Yeah, there might be some level, but go find that out. You can Google that, right? That's a simple Google search, or an AI search, and you will find that answer. Um, I know that all these companies want younger investors. Um, and I don't think it's that old. It might be 18, might be 17, 15, 21, we're somewhere in there. Um, but even playing online or playing with like I said, that fake money, those simulations is also a way without age requirement. You can sign up for an account and even trade that way if you're young and can't have an account yet yourself, you can still learn and practice. And please just Google that Schwab question. I don't know it offhand, and I don't want to give you the wrong information. But even with parent signatures, even if it takes a cosigner, maybe so be it. And start with again a small money that you're prepared to lose, as I mentioned. But learning that way is wonderful. It'll be the best investment you make.
All right, sounds good. All right, we just want to give a big thank you for all of you for joining us. We hope that you found this webinar useful and that you're walking away with some great financial and investing tips. This slideshow will also be sent out to all of you along with the recording on our YouTube channel. So it's at Weston Financial Literacy on YouTube. So keep an eye out for that.
Also, if you guys have any further questions or if you want to continue this conversation, feel free to reach out to any of our financial literacy club members. Um, and as mentioned earlier in the slideshow, joining economic and financial clubs are super important. So if you attend Weston High School or you will next year, definitely keep an eye out for our club, the Weston Financial Literacy Club, at the activity fair.
We also just want to give a big thank you to Mr. Mortimer for sharing your time and expertise with us, and also to everyone being a part of today's event. Keep an eye out on our Instagram at whsfinancial.lit for upcoming other webinars, as next year we'll be having one about every month or so. And we hope that you all have a great night, and we hope to see you at our next session. Thank you.
Thank you.
Bye now.